Then and let's touch base with the management of KEC International. Mr. Vimal Kejriwal, MD and CEO at KEC International, is now joining us. Mr. Kejriwal, afternoon, and thank you so much for joining us today. You've won a big order worth over 1,000 crores across your business verticals. First up, if we can talk about that, what is the execution timeline for this particular order that you've won, especially for luxury villas and metals and mining projects, and what is the total order book size now?
Good afternoon, and thank you for having me. If you look at the orders which we released yesterday, 1,000 crores, roughly 500 crores are from the civil, including the villa order which you talked about, and the rest are across the businesses. Our total order book, including L1, is around 42,000. I think 38,000 in order book, and 4,000 crores are L1. Typically, most of our orders, and this is a variety of orders, gets executed between 12 months to 24 months. The villa order probably is slightly longer because it will be done in stages. So I'm not sure. I think it's around 3 years from now for the entire project to be delivered.
Right, Mr. Kejriwal, hi, this is Ankita also joining in. With the wide year-to-date order, intake that's up to 17%. Are you revising your FY26 revenue and your execution guidance now?
No, as of now, I don't think we are revising it. Our order intake target is fairly aggressive at 30,000 crores. We have done 17. That's around 4,000 is L1. So I think we are, just about reaching that number. On revenue, we'll have to keep a watch and seeing what's happening. Right now, our target is 15%. So with that, we should be crossing 25,000 crores of revenue for the year. So as of now, we are not revisiting our targets, but let's see what happens.
Understood. But let's also talk about the segment-wise performance then. I was going through some notes, and although the T&D performance was very strong in the second quarter, brokerage houses and analysts believe that non-T&D segment will likely take some more time to improve, especially because two segments reported a decline in revenue. One is the railway segment and second is the civil segment. Your thoughts on this part of the business?
So the first half has been slightly disappointing for us for these two segments, but I'll say most of them were expected because railways, considering the issues which all the large companies have been facing on execution, we have been deliberately slowing it down. If you look at it a couple of years back, we were at 4,000 crores. Today, we are targeting 2,000 crores. And I think that's where we will continue. We have an order book of more than 3,000 crores in railways. Civil, I think the reason is twofold. One is we are actually doing 4 large metro projects, of which 3 have been completed. So the revenue has come down in that segment, and we have not taken any large order as of now. And the second component of the civil, why it came down, has been on the water side, where everyone is aware of the payment problems under the Jal Jeevan mission. So because of that, the execution is very, I'll say, calibrated based on what cash we get. So it's not been a big surprise. However, we have a large order book. If you look at civil, we have an order book of almost close to 10,000 crores. So we do expect that civil will see a significant uptick in revenue, let's say from now onwards till the end of the year. And definitely next year will be a big uptick.
Right. Mr. Kejriwal, in the metals and plant win, how strong is the order pipeline and margin in this subsegment?
So typically our margins would be around, let's say give or take a 10% when we are bidding. And uptick continues. Okay, we have been looking at uptick in steel. We have been looking at in copper, aluminum, even in zinc to that extent. So I think that's the biggest growth sector for us in our industrial vertical.
Okay, so that's as far as the segment-wise performance is concerned. But on a consolidated basis, if we look at the margins, they've improved to about 7.1% in the second quarter. And I was going through your financials. They've been in that 5 to 7% range for the last several quarters. Any margin expansion plans or execution plans that you're undertaking to ensure that EBITDA margins break past that 7% mark?
So you're right. We increased our margins by 80 basis points this quarter from 6.3 to 7.1. Our target has been that we should be able to reach around 8% for the year, which effectively means that H2 has to be at a higher level than what we are, because I think the H1 our overall numbers were 7%. So 7 to 8 for the year will mean a considerable increase in the margins. So that's what it is. As far as the expansion plans are concerned, we are a EPC company. So not much of expansion that way. But what we did was looking at the T&D market. We have expanded capacity in three of our out of the four plants we have. Three we have expanded, and the fourth one is under expansion. So our production capacity in transmission towers is increasing significantly.
Right. Mr. Kejriwal, also, the first oil and gas order in the GCC. How large is the addressable market and what is the expected order pipeline?
So for us, it's a huge market because we are not there. So whatever we can get, let's say 1,000 crore, 2,000 crore is going to be a large market for us. The current order is a very small because it was just let's say, just getting into that market. And we have been approved by another utility also in that market now. So I think we'll start seeing more action happening. But I think with whatever is happening on the T&D sector, we are not pushing the other sectors very aggressively. So there's a large market. I'll not be able to give a number to it. But for me, from zero, even if we reach 1,000 crore, 2,000 crore, that's a good enough number for me.
Understood. So, EBITDA margin guidance of 8% for FY26 also means that second half of the year will be very positive. T&D segment outlook is also very positive, and so is the case for the cable segment. Thank you so much, Mr. Kejriwal, for taking your time out and joining us this afternoon on ET Now and helping us understand what the outlook is going forward. On that note, we need to slip into a very short break, but one more